Hello students, my name is Gaurav Bansal and we are going to start this next video in our series for the PT 2023 revision. The next topic is the bonds market. It's always a very important topic. Very regularly you see PT questions from this topic and there are many conceptual tough areas in this topic. So first we are going to discuss the various facts and concepts related to the bonds, and after that we will come to the previous year questions and other practice MCQs. So let us start our discussion. The first topic is the types of bonds. In the types of bonds, we have the government bonds. So first of all, if we talk about government bond, majorly two types of bonds that we have here. The first type is the coupon bonds. Coupon bonds are those which pay you fixed interest. Pay fixed interest. Okay, so for example, you purchase a bond worth 5 crore rupees. You pay 5 crore rupees today and every year it will pay you interest. Let us say it will pay you 35 lakh rupees as an interest every year. So that is how a coupon bond will work. Let us say this bond is for 10-year maturity. So up to 10 years, it will continue to pay 35 lakh rupees worth of interest. The most common type of government bond, however, are zero coupon bonds. In the case of zero coupon bonds, government doesn't commit any fixed interest. What government rather does, government offer these on a discount. So zero coupon do not pay you interest technically. What they do is something like this. Let us say there is a bond which is worth 5 crore rupees, but it is not worth 5 crore today. It will be worth 5 crore after 10 years. So this bond has a face value of 5 crore. Okay, so 5 crore is the face value. And let us say maturity date is after 10 years. So that is 1st April 2033. Let us say this bond matures on 1st of April 2033. So this bond will be worth 5 crore on this specific date. Not before that. Now government issues this bond. A bank purchased this bond. But bank will not pay 5 crore obviously, because bank would like to have some interest, some return on the investment. So a bond will be purchased by a bank on a discount. This discount will be on face value. So 5 crore rupees is the face value. Let us say bank will compete with each other and they will target something like that. Let us say bank 1 will argue or not, it will bid 3 crore that I am ready to pay 3 crore for this bond. Another bank say, okay, I'm ready to pay 3.1 crore for this bond. So depending upon who quotes the highest, the bank or the institution is going to get the bond. Government want to get maximum money on this bond today. Government has to give 5 crore after 10 years. But today, whatever government can get maximum against that, that will be benefit to government. So banks compete against each other to decide what will be the bond price. Bond price is the price at which bond is selling today. Okay. Whereas face value is the maximum value. Face value is maximum value a bond can ever achieve. And generally this value is achieved on the maturity date. So that is how most of the government bonds work. Some government bonds, however, can be coupon bonds. Coupon bonds which pay you interest. There is no concept of discount, etc. Simply you pay this much of money, every year you get that much of interest. So those bonds are also there, but most common bonds are zero coupon bonds. Now, even the coupon bond that government issue are fixed coupon bond, means government pay fixed interest. So these are the two types of government bonds. I hope the concept of government bond now is clear to you. So government always pay a fixed amount because in government budgeting, certainty is one of the most important virtue. Government doesn't want to face fluctuations, uncertainty because of change in interest rate. So government commits itself to a certain interest rate or to a certain payable maximum amount in the case of zero coupon bonds. These bonds are the primary instrument to finance the deficit. Means when government has to spend more than its income, then extra money can be arranged by selling these bonds and getting cash today. So this is precisely how these bonds work. Now, coming to the next area, that is Treasury Bill. Now, Treasury Bill is exactly like bonds, okay, but they are for short duration. They are issued for 14 days, 91 days, 182 days, and 364 days. Means they cannot be for more than 1 year loan. They are issued sorry, they are issued for up to 1 year loan. Now they are also issued only by center, means states do not issue them. Okay, so while through bonds we finance deficit, with Treasury Bill we typically do not finance the deficit, means we do not cover the gap between revenue and expenditure. Generally the purpose of Treasury Bill is that with Treasury Bill we will cover the revenue mismatch. The budget is always a projection for the coming year. So for example, we expected 15 crore rupees per day revenue, but however in the first quarter revenue is only 14 crore per day and government is able to get less than what it projected for. Now since government is getting less, government can arrange for some money for short term through Treasury Bill. This much amount should be paid within the ongoing budget period. Okay, so that is why the durations are like this. So this is about the Treasury Bill. Next, corporate bonds. Now corporate bonds can be issued by any non-government entity. It can be PSU. Lot of students make mistake here. Corporate bond doesn't mean only private sector. It can be PSUs also. Okay. The requirement is that such firms need to be registered or need to have board of director or a corporate structure. For raising money through corporate bonds, such companies must have some secured assets. Means those companies should have some land, some other property, some factory value, some inventory. Okay, so in case they are not able to pay, then money can be recovered through other assets. Entire amount is not supposed to be secured, but against a certain amount, there has to be some secured asset with the company. SEBI verify this, and hence a corporate bond can only be issued after SEBI verification. Okay, so each and every corporate bond issue is approved by SEBI. Very similar to corporate bonds are commercial paper. Commercial paper are also approved by SEBI and they're very much like corporate bonds. But they are non-secured short-term loans for very small amount, and commercial papers generally have up to 1 year maturity. So this is about commercial paper. Now we come to municipal bonds. Municipal bonds are a recent phenomenon under which the municipal corporations are allowed to raise money directly through the market. However, for issuing a municipal bond, they must have investment grade rating. And again, SEBI verify, and the permissions are to be required by municipal boards for taking loans. So only those municipal bodies which have good budget, which are able to tax a lot, which have good income, which have sustainable income sources, only they are allowed to take loan. It's not that any municipal body can take a loan through bond or can raise debt through the bonds. Only certain municipal bodies with investment grade ratings. For you, further technicalities are not required. This much is enough. Investment grade rating is enough for us to know. Who provides these ratings? There are independent credit rating agencies, okay, like CRISIL, ICRA, etc. So they provide rating, and again it is SEBI which has a role and responsibility here. The most common municipal bodies which issue bonds are in Gujarat, Maharashtra, or in Madhya Pradesh. Indore Municipal Board or the municipal body, Surat Municipal Body, Ahmedabad Municipal Body, Mumbai Mahanagarpalika, etc. These are some of the bodies which have issued the municipal bonds. Okay, these are examples. Next are tax-free bonds. Okay, so tax-free bonds cannot be issued by any corporation. They are issued only through government approval and by select corporations such as Indian Railways, National Highway Authority of India. So they provide the buyer certain tax advantages. For example, interest that you earn on these bonds is tax-free. So very much like other bonds, there is only one special feature. No need to discuss further. Just need to remember this particular thing. Issued by government entities. Okay. Next, infrastructure bonds. Now, nothing very special about it. Just like the other bonds, just like the corporate bonds. And these are bonds issued by eligible infrastructure companies and infrastructure projects. So, in order to issue infrastructure bonds, you need approval from Government of India, or basically a permission or a certification from the Government of India, and it cannot be issued for any project. Basically, let us say if a company is not approved to issue infrastructure bond, it can issue normal corporate bond and get money. So getting money will not be problem. What infrastructure bond do for a company is that when a company issue infrastructure bond, it is very easy to sell the bond, because banks which have not completed their priority sector lending target, they buy these bonds easily, because buying these bonds contributes to such lending. So infrastructure bonds benefits the people who buy the bonds, and obviously it also help those who issue the bond, because they may have to pay less interest also. So not a very different type of a bond. It is more about certification. Later we will see that there are green bonds, blue bonds, social impact bond, which are very much like this. Next is zero coupon bond. This we have already discussed with the government bonds. Zero coupon bond which do not pay interest. Rather, they are sold at a discount on their face value, and then they mature at the face value. Okay, face value is the maximum value on the maturity date. Since zero coupon bond do not pay interest, for these bonds we calculate bond yield. Bond yield itself is a very technical and a very complex topic. We will discuss this. First, let us complete the types of bond. I will talk about the bond yield. Next is coupon bonds. So these are bonds which pay regular interest to the holders, people who have the bonds. who are keeping it until the maturity date. So the interest rate may be fixed like in government bonds, it may be variable or fixed like in corporate bond. Corporate bonds generally offer variable or fixed both alternatively. Okay. Next, zero coupon, zero principal. This is very interesting because it would mean no repayment. Means if I purchase a bond, I will not get anything against it. Neither I will get any interest nor I will get my money back. So basically this is same as donation. This is just another name for donation. Now what is the context of zero coupon, zero principal bond? So Government of India is about to launch a social stock exchange. On this social stock exchange, we are going to list the NGOs, the non-government organization, non-for-profit organization. And such corporations basically are going to get donation through the stock exchange like institution. And when you are going to buy the bond for those NGOs, essentially you are donating to those NGOs. But what is the advantage? The advantage is that when a company issue bond, it has to declare all its financial details. Just like that, NGOs will have to become more transparent because of this effort. So this is about the bonds that we have mentioned here. Let us move to the next page. Yes. The next is green bonds. Now green bonds are issued by any company, whether PSU, whether private, when they are financing any environmentally sustainable project or a project which is going to help with the climate change mitigation, or a project which is related to clean energy or is going to benefit the environment. So there are long list of such projects which can be rated or certified as green bonds. Okay, for which green bonds can be issued. Now, in India, SEBI has to approve any green bond application, whether the company that is going to take the money against a green bond is actually going to use the money for that purpose or not. So for that, there are audits, there are cross checks. What is the advantage? The advantage is that the company which will issue green bond will be able to pay less interest on these bonds because there are a lot of buyers for green bonds. Basically, when we sell green bond, we tell the buyer that the money you are putting into this bond is going to be environmentally useful also. You are making a sensible investment, not just in terms of your development, but for planet's development, but for sustainable development for coming generations also. So people are ready to get less interest. There are a lot of people, in fact corporations, which say, okay, we will contribute to many environmentally beneficial projects. We will buy green bond, even if it pay less interest. So basically as a company, if you can get certification for your project as a green project and you can issue green bond, you will pay less interest. So that is the advantage of green bond. For international markets, there is even bigger demand. And today this market is trillions of dollars almost. India's participation is still very low. And if you want to issue international green bonds, you need certification from international organizations. World Bank certification is considered to be very authentic. If you have World Bank certification that your project is green, then it is very easy to sell that bond, because for those companies abroad, it will contribute to their carbon credits also. Now, what is carbon credit? That is a separate topic. I can't divulge too much from my topic. If you have a doubt regarding carbon credit, I will cover a separate concept note on Pigouvian tax. Over there, I will relate. Next is blue bond. Very similar to the green bond. It is also a certification. And it also works the same way. It benefits the company issuing the bond, and they have to pay less interest, whereas the buyer is quite clear that they are contributing to certain sustainable development process. So they are aimed at financing projects that promote marine conservation, sustainability in each area of ocean conservation, fisheries management, and marine habitat protection. So, again, for a good purpose, if you want to do something, you can get certification for your bond, and then there will be buyers who will be ready to give you money even at low interest. So, both of these work like that, and that is how the infrastructure bonds also work. Infrastructure bonds are very much domestic, whereas both of these are international type of bonds. They can be issued in domestic market and in international market as well. Then we have social impact bonds. Again, very similar to what we have discussed earlier. When a company issues social impact bond, it means that the money raised through these bonds will be used for advantage of society as a whole. It will be used for social benefits, social work. So it will be contributing to education, health. It will be challenging the issues of hunger. It will be working on the issues of poverty as well. And there are many more like that. So if you are working on such projects where you spend money in order to help people, you can get social impact bond ratings, certifications. And once you are rated or certified with social impact or socially sensitive or socially beneficial project for which you can issue social impact bond, then again at very low interest you will be able to raise money. So basically all these three are certification process which help a company to raise money at low interest, provided they are contributing to society either through climate support, marine conservation, or through working for people. Next page. Now, some of the other terminology related to the bonds, that is bearer bonds and non-bearer bonds. So bearer bonds are physical certificates. Basically a certificate like a currency. Okay, like you have a currency note of 500 rupees. As long as you have 500 rupees currency note, you can spend it, you can get anything against it. Exactly like that, bearer bonds work like cash. Having this bond means you can use it, but it is not registered in anybody's name. It is not specifically belonging to anyone. Just like a currency note. Currency note specifically doesn't belong to anyone. It belongs to the person who is carrying the currency note. And exactly like that, bearer bond belongs to the person who is carrying the bond. So, since they do not have any registered owner and no track record of transactions, ownership, etc., they were used for black money, money laundering, even extortion. So criminals preferred getting bearer bonds. So bearer bonds were as good as cash. India has phased them out. We'll talk about it. First we talk about non-bearer bonds here. Non-bearer bonds, simply the registered bonds. Bonds which are registered in your name. Even if you lose the physical certificate, the document, you can still get the money because it is registered against your name. Your digital certificate is there. It is recorded digitally, in fact. So the current situation in India is that the bearer bonds are not allowed in India anymore, and it was discontinued in 2002 to curb the money laundering and the other activities. It was used for terror financing also. So under the TADA, which was a very notorious act, it was made an offense to issue such bonds. Now, non-bearer bonds are the common type of bonds that are issued in India. And these bonds, which are all non-bearer by the way, because bearer bonds are no longer used in India, so all the bonds are non-bearer. All bonds are non-bearer. If a statement like this come, you can take it. There is one exception although, but that is a very special exception, and that is electoral bond. That you have to keep in mind, and we'll talk about it. That is mentioned on the next page. Now, what is the organizational structure? Basically, they are issued in digital format, which we call demat format. You must have heard of demat accounts where stock, shares, etc. are kept. So exactly in those accounts, bonds are also stored. Okay, demat accounts are used for stocks. All the stocks today are dematerialized. They are no longer physical papers. Okay, similarly, many other financial instruments, they are stored in your demat accounts as dematerialized, and they are maintained with organizations like NSDL, National Security Depository Limited, or CDSL, Central Depository Services Limited. So these are two of the primary bodies with which your broker, through a broker only, you can buy the bonds or the shares. So your broker has services from either of NSDL or CDSL. Depending upon who your broker is, you have an account with either of these organizations, and that is where your stocks, bond, etc. are stored. So this is about how we maintain the bonds. So that is all here. Let us move to the next page. On the next page, we have two more terms, and I will in addition discuss two more concepts before we move to the questions. The next is electoral bonds. The electoral bonds were issued in 2017, and they were issued to bring transparency and accountability, although the electoral bonds are bearer bond. Electoral bonds are bearer bonds. Means they are without any track record or registered ownership. Anybody can buy a bond, and by buying a bond, they can contribute to a political party. So after that, entire record is kept. How much bonds a political party has sold, how much money it has received. And by the way, these bonds are also zero coupon and zero principal. Remember this. Zero coupon, zero principal. So electoral bonds have two features. They are bearer bonds, and they are also zero coupon, zero principal. When you buy these bonds, you do not get anything in exchange. Basically, you are making a donation. So I used this term earlier also, that zero coupon, zero principal bonds are basically donation. So that is all about electoral bonds. Your PT question should not go beyond these 2-3 points. Next is Masala Bond. Now Masala Bond is what? Masala basically represents India. It is a symbol of India, like elephant, like tiger. Like China is often symbolized by a dragon. So just like that, India is often symbolized by peacock, elephant, tiger, masala, spices. So these are some of the identities of India, symbols of India. Masala bonds simply signify that these are the bonds from India in international market. That is it. But there is one very special feature, that they are rupee denominated. Okay, for example, a company wants to get $1 crore from international market. If a company is going to get $1 crore in rupee terms, it would get something like 82 crore rupees in India today. When a company is taking those 82 crore rupees, let us say its agreement was to repay $1.2 crore after 2 years or 3 years, let us say. So after 3 years, this company was supposed to repay $1.2 crore. When company took the loan, it meant company is taking roughly 82 crore rupees today, and it will roughly repay 100 crore rupees after 3 years, because 1.2 crore rupee at 82 exchange rate would be roughly equal to 100 crore or 99 crore. Let us say 99 crore. So this company was supposed to pay back 99 crore rupees after 3 years. But meanwhile, the rupee fell to 90 against dollar. The rupee is now 90 per dollar. Let us say the rupee fell. Now this company had to pay 1.2 crore dollar, and at the new exchange rate 90 per dollar, this would mean that this company is now going to pay 108 crore rupees as the principal and interest, maybe more. Sorry, not 108, in fact, little more than that. But anyways, the point is, the company will have to pay far more rupees to international buyers of these bonds. Here, exchange rate fall has affected the company's repayment. And there is an alternate to it, and the alternate is that we do not take dollar denominated bond. We do not take dollar denominated bond, rather we take rupee denominated loan. That means that I am taking 80 crore rupees today, and I have to pay back 100 crore rupees after 3 years. Whether after 3 years, in dollar terms, 100 crore is less than the 80 crore. Let me work out an example. Let us say when I took a loan, $1 was equal to 80 rupees. So when I took the loan, basically I took $1 crore from a foreigner or a foreign bank. Now after 3 years, let us say rupee has fallen, and today $1 is 120 rupees. I will still be paying only 100 crore rupees. So to the bank from which I took loan, I will only be paying, let us say, 0.85 crore dollar, because 100 crore rupee today is only 0.85 crore dollar due to the new exchange rate. So this loss now belongs to bank, not to the company which is taking the loan. So it is suggested that Indian companies should take loan in rupee denomination. Yes, it is difficult to sell those bonds, because basically you are transferring your risk to the other corporation. So Masala bonds are basically rupee denominated bonds. They have an issue that we have to pay higher interest compared to a foreign currency denominated bond. But overall, companies mitigate the risk. They reduce their risk. So this is the advantage of Masala bonds. So I hope this is also clear. Now, let us discuss two more concepts. One is convertible bond. Convertible bonds are those which have features of both debt plus equity. Now, let us say a company issue a bond, and the bond has this feature. Anybody who purchased the bond, let us say the bond is worth 5 crore rupees, and bond is going to mature in 2028. It has 5-year maturity date. Today, companies selling these bonds for 3.2 crore rupees. Okay. Let us say these are zero coupon bonds which are sold at 3.2 crore rupees. So far they look like any standard bond, but they have one more extra feature. They are also equal to 1% shares of company. So after 5 years, when I am maturing these bonds, I have a option. If either I can take 5 crore rupees or I can take 1% shares of the company against this certificate. If the company has done very well in the period of 5 years and the company's shares have jumped up, let us say the value of company share is now 12 crore rupees. In that case, I can get 12 crore rupees instead of 5 crore rupees. That is the advantage to the person buying the convertible bond. Obviously, when you are offering some advantage to the buyer of bond, you will pay less interest. So, convertible bonds are issued at a lower interest. And generally, for convertible bonds, we use the term debenture. Okay, so corporate bonds are non-convertible debentures. That is how we define them. And convertible bonds are debentures. So, precisely that is convertible bond. They can be converted into stock at maturity or any other asset, depending upon what is the agreement. Next is bond yield. Now, what is bond yield? Basically, on the zero coupon bonds, interest is not paid. So how anybody can identify how much they are going to get? Because that doesn't mean the person who is going to buy the bond is not going to earn. They will earn through discount. So instead of saying that I am paying interest, what you are essentially doing, you are offering discount. You are selling something which will become higher in value in future, and you are selling it on a lower price today, so that you will pay more in future. So this works exactly like interest, but still it is not interest. So for those bonds, basically what we do, we calculate the bond yield. So bond yield is basically earning that a bond buyer is going to get through holding a bond. So you are a buyer of bond. If you hold this bond until maturity, basically bond yield is the interest you are going to get. Or if you look at it from the company which issue the bond, then it would be the cost of the loan. So bond yield works this way. Basically, this is the rate of interest. Okay, so let us get back to this. There are 2-3 concepts related to bond yield. First of all, it is directly proportional to interest rate. Remember this simply. If interest rate high, if interest rate increase, bond yield increase. So this is how the bond yield works. Basically, this is the interest. So this is the indirect calculation of interest. So obviously, this is directly related to the interest rate. If the bank is going to pay more interest on the fixed deposit, then companies which are issuing bond will also have to pay more to the buyers of bonds. Otherwise, they will not be able to sell the bond, because your competition is paying interest, and if your competition start paying more, interest increase, you also have to pay more in the form of yield. So basically, you give them more discount. So bond yield is also directly related to discount. Higher discount means higher bond yield. Okay, remember these relationships. Bond yield is directly related to interest rate. Bond yield is directly related to discount. And then next is bond yield is inversely related to the bond price. So if bond price increase, yield falls. Or other way around, if bond price decrease, yield increase. Now remember, the face value is basically the bond price plus discount. Okay, so for example, a bond has face value 5 crore. It's sell today for 3.15 crore. That means on this bond 1.85 crore rupees worth of discount was given. This is exactly what it means. So face value will always be equal to bond price plus discount. Now your discount is directly related to bond yield. So since both of them together are fixed, face value is fixed. If discount is going to increase, bond price is going to rise. If bond price is going to increase, discount is going to fall. Since discount and bond yield are roughly similar, basically bond price, if it increase, it will shrink the yield, and if bond price falls, it will enhance the yield. That is exactly how it works. I hope now it is clear. If you still have a doubt, kindly provide a comment in the video. I will comment and I will help you out in that. Now we have completed the discussion on the bonds. Now, although I am covering this discussion for PT 2023 specifically, but what I have discussed so far is almost entirely conceptual, and it will be useful for all the students in any year. So this video is very much relevant even after the PT 2023. So even if you are watching this video after PT, you can still be benefited from it. Now let us move to the question. Just give me 1 second, please. Question number 1 is, the Indian government bond yields are influenced by which of the following? Indian government bond yields. Okay, basically what government has to pay. Okay, so from buyer's angles, it will be how much I'm going to earn. Whereas if you are issuing bond, if you are taking a loan, then how much I have to pay. That would be the perspective. Action of the United States Federal Reserve. Now, US Fed issues American bonds or determine their price. Now, since US Fed, it doesn't issue, it auctions the bond. So, since it helps in auctioning of those bonds, it performs the similar role to RBI in India. So, the Federal Reserve, if it is going to change its policy, the US bonds can be more competitive, they can be less competitive. So US bond yield are affected by the US Fed. And since that is a competitive product, we also have to adjust. If US pay much higher interest, then we also have to pay much higher interest. So that is how it works. So first affects. Second, action of RBI. Obviously, if RBI decides to sell many more bonds, then it will affect the bond prices. So RBI action definitely affects. Inflation and short-term interest rate. So if your economy has inflation, then bond prices have to change. If interest rate become too low compared to inflation, nobody will going to buy the bonds. Similarly, short-term interest, whether short-term or long-term, both affect the bond prices. So all of these 1, 2 and 3 affect the bond prices or the yields. Next question. With reference to the Indian economy, consider the following statement. Commercial paper is a short-term unsecured promissory note. That is correct. Okay, it is short term. We discussed it, less than 1 year, and it is less than it is unsecured compared to corporate bond, which is secured. That also I discussed. And by the way, all the bonds are promissory note. What are promissory note? It will be beyond the topic, so I will not go into that detail right now. That may be for another video. Maybe I'll do another video on money market instruments and the capital market instruments. There I can tackle the promissory notes. All the financial instruments basically are promissory note, where you promise to pay in future. Certificate of deposit is a long-term instrument issued by RBI to corporation. RBI never issue any certificate of deposit. It is issued by banks to the corporation. They can be long run as well, generally short term although. Second is wrong. Not by RBI and generally not long term. If it is written certificate of deposit can be a long-term instrument issued by banks to corporation, then it would be correct. Third, call money is a short-term finance used for interbank transactions. This is perfectly correct. When bank take loan from each other for 24 hours, it is called call money. Generally, you take such a small duration loan for settlement of payments and not for other purposes. So this is perfectly correct. Fourth, zero coupon bonds are the interest bearing short term bonds. Already wrong. Zero coupon means no interest. Interest in the context of a bond means coupon. So I hope it is clear. In this case, 1 and 3 are correct. So C should be the answer. Next page. Question number 3. Which one of the following is not the most likely measure the government or RBI takes to stop the slide of the Indian rupee? So basically RBI is trying to affect the exchange rate. Now when RBI would be trying to affect the exchange rate, it will opt for a So when RBI would be trying to stop the slide of Indian rupee or basically to affect the exchange rate, in this case RBI would follow a tight monetary policy. RBI needs to control inflation. Inflation decreases the value of a currency. Okay, inflation. When things become more expensive, your currency becomes less worthy. That is why inflation reduces the value of currency. If you control inflation, basically you can stop the deterioration of your currency. So that is why controlling inflation is the target when you want to control the depreciation. This is the standard system. Control of inflation for depreciation. Now, for that we follow tight monetary policy, means we reduce money supply. I've already discussed video on monetary policy. In case you are not able to get these, then on my channel you can find video on monetary policy. Kindly check that out. We increase interest rate. So this is what we do when we try to follow the tight monetary policy. Let us look at the options. First of all, curbing import of non-essential goods and promoting exports. That is correct. Okay. We have to identify which is not the most likely measure. So this is correct measure. If we want to save the rupee from depreciation, the first policy would be to address the trade balance. Second, encouraging Indian borrower to issue rupee denominated Masala Bond. This is also correct. That would reduce the burden on Indian companies. Easing conditions related to external commercial borrowing. This will also be useful in the short run only. If more companies are going to take loan from abroad, then more dollars are going to come into the economy in the short run right now. We may have to pay back more dollars in future, but that is in future. Right now we need dollars, we got dollars. So even this can be useful, not very good policy, but it can be useful. Next, following an expansionary monetary policy. This is wrong. because we need to follow tight monetary policy. This is exactly opposite. It will encourage inflation, will reduce the value of rupee further. So answer is D. Question number 4. With reference to Indian economy, what are the advantages of inflation index bonds? IIB. Inflation index bonds are those which pay you either a certain rate of interest or the minimum inflation. Let us say there is a bond you buy today. The bond has face value of 5 crore. Its duration, maturity period is 5 years. And it is issued, or basically you can buy it for 3.5 crore rupees. So buying this bond for 3.5 crore rupees, you will get 1.5 crore rupees over 5 years. So roughly 40% return in 5 years. Eventually this would be about 7% interest per year, or little less than that per year. So that is what it is going to mean here. Now, for some reason, inflation is 40%. Inflation is 40%. Then it is possible in 5 years, something which was worth 3 crore would actually become worth 10 crore. So basically, you are worse off by purchase of this bond. You purchase this bond for 3.5 crore rupees. After 5 years, you get 5 crore rupees. But today, the 3.5 crore rupees would be worth 12 crore or 11 crore, not 5 crore. So what you are getting today is less than what you gave them. In purchasing power, it is less than what you gave them. So if this bond would be inflation index, that this will pay you at least the inflation rate, then you will get 40% return at least. You will get 11 crore here. Okay, so bonds which are inflation indexed, they can cover up the inflation in case inflation is more than the interest. You can get either of these. It is not possible to get both. And generally 40% inflation is something that we have never experienced in India. Even if we experience something like 12-13% or going up to 14-15%, we call it extreme inflation, because generally we observe inflation in the range of 6%. Okay, 4% to 6% is what we generally observe. When inflation is high, when there are some issues, we experience 10-11%. So interest rates are in the range of 8, 9, this range. So usually the inflation is about 4 to 6, interest rates are about 7 to 8 or 8 to 9. So interest rates are more than inflation. But sometimes when inflation is high at 10 or 11, you would be eligible to get 10 to 11% return on those bonds. So any company which will issue such bonds will pay you less interest, because it is benefiting you in other way. It is securing your risk. Now, government can reduce the coupon rates on its borrowing by the way of IIB. That is correct. You can offer less rate of interest. Second, IIB provide protection to the investor from uncertainty regarding inflation. That is exactly what we have discussed. So first is correct, second is correct. Third, the interest received as well as the capital gain on IIB are not taxable. That is incorrect. These are taxable. So answer would be A, 1 and 2 only. Next question. Question 5. With reference to the convertible bonds, consider the following statement. Now we are going to talk about convertible bonds. As there is an option to exchange the bond for equity, shares, convertible bonds pay a lower rate of interest. This statement is very similar to the previous statement. And by the way, all of these are previous year question. This question came just last year. So all of these are very relevant question. Okay, good technical question, I would say. So this is correct. Convertible bonds can pay you lower rate of interest. I covered this when I was talking about convertible bonds. If you are not able to recall, please rewind this video where I was discussing convertible bond and you will find this discussion. The option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. That is also correct. Because equity is more sensitive to the inflation. Equity prices change with inflation compared to bonds, unless bonds are inflation indexed. So yes, this offers some degree. Okay, not complete indexation. It is not same as inflation indexing, but it provides some coverage. So 1 and 2 both are correct. Answer should be C. Sixth, again a previous year question. Consider the following statements. Inflation benefits the debtor. Inflation benefits the bondholder. Now first of all, inflation benefits the debtor means who take loan. So if inflation is more, basically they will be paying the same money, but worth of that money would be less, means the value of that money today would be less. So they will be at benefit. Inflation decreases the value of rupee. So when you took the loan, the value of that rupee was much more, but when you are repaying the loan, value of that money is much less. Let me give you an example. I take a home loan today. Home loan is for 20 years. Today as I start paying EMI. Today the EMI is 25,000 rupees per month. After 20 years, I would still be paying 25,000 rupees EMI. By that time, my income would be multiple times today. By that time, 25,000 rupees would be worth much less than today. So for me, paying that EMI would be much better. Contrast to that, if there is no inflation, then 25,000 rupees would not deteriorate that much. So higher the inflation, more will be the fall in the value of money, and those who take loan will be at advantage. So 1 is correct. Second, inflation benefit the bondholders. Bondholder is someone who has given loan, not someone who has taken loan. Okay, the one who is going to give a loan is definitely at a disadvantage. So it can't be both. So second is wrong. In this case, only 1 is correct. A is the answer for 6. Next question. Now we have covered the PYQs. Let us look at some MCQ. Question number 7. With reference to Indian economy, which of the following statement given below regarding bond yield is correct? Okay. Bond yield is the subject of the question. Bond yield is the return the government gets on the bond issued by it. Is it correct? No. Government pays. Okay, government pay the interest. Bond yield is not affected by monetary policy of central bank. Wrong. Monetary policy of central bank can change the interest rate, and that will very much change the bond yield. Third, a rise in interest rate cause bond yield to rise. That is correct. Bond yield, remember I told you, is directly proportional to the interest rate, and it is inversely proportional to the price. If the bond yield goes up, it results in capital inflow into equity. This is wrong. If bond yields go up, it will result in capital inflow into the bonds, not in equities, into debt. Okay, because debt are safe assets and they are giving you more interest, so obviously more people will be buying bonds rather than stocks. So D is also wrong. C is the answer. 8th and last question for this discussion. Consider the following statements with respect to the municipal bond. It is an instrument that allows investor to purchase equity in local government projects. Equity is wrong here. The statement otherwise was looking correct. Even I was confused for one moment because I was not able to locate the word equity. So this is tough. In a way, perfectly written statement, just one word. Okay, sometimes this, not very tough, I mean, but tough in the sense sometimes we can miss out just one word change or swap. So bonds are always debt, never equity. Second, they must have a rating above the investment grade for the public issue. That is correct. Okay, municipal bond must be investment grade. This I discussed when I was talking about municipal bonds. These bonds cannot be traded in secondary markets, which makes them less attractive. This is wrong. Okay, these are very well traded in secondary markets. So answer is 2 only, A. So with this, I have completed this discussion, and I hope this discussion has been helpful to you and you have benefited. Now, if you feel that this discussion has benefited you, kindly subscribe this channel and share this video more and more with your friends who will also benefit from this video. Also, do not forget to comment on the video. This improves the validity of the video in the YouTube algorithm. The YouTube believes that any video which is generating more comments, which is inviting people to write, engage, that video is good because it must have some engaging material. So please do leave comments, do subscribe the channel, do share.